Welcome to Java. Thank you all kindly for joining me. It is February 18th, 2025, and it is also Tuesday. And I'd like to thank everybody for being here. I appreciate you so much. I definitely would not be here without you. So thank you so much for everyone that comes here and all of your support. I can't thank you enough. So with all of this, there's quite a bit going on right now, pre-market, and we've also got a lot of things to cover. So with this, let's go right into, as we normally do with the markets, our risk factors. And while this is mostly for our traders, particularly if you're new here, this kind of does direct a lot of the other things that will happen with some of the other things in our daily lives. So, starting with the MMRIs, our main risk indicator. Now, MMRI, the main one we normally use from Greg Manorino directly, is still down. So we've got it right now below 300. This is from another friend of ours that we use from our YouTube channel. So we're still in high risk territory. However, it's still kind of hovering here, not doing severe movements. So with that, it's not that concerning, at least. On the overall now, we've got the fear greed meter is 44. And this means there's still quite a bit of retailers jumping in here. In fact, it's moving much more towards the greed just as this is opening. We've got a mixed open. So our daily driver right now is neutral before a shift. I sense a bit of a shift in the markets. A couple of underlyings, we'll talk about that in a moment. But we've got debt and unemployment, I believe, are about to be exposed for some of the real numbers that have actually been going on that people have been sensing, but that they're kind of juiced numbers, if you will, in the reports have kind of been papering over with the problems. Now, we've got the 10-year yield is rising on the view that there will not be any cuts. So just above 4.5 right now. We've got 5% is kind of a very high level warning area, in my opinion, right now, in particular if it happens in a rapid fashion. Now, the relative strength of the dollar pulling back a little bit. It's below 107, so this is giving other currencies a little bit of room. We've got a little bit of trade room going on. So Asian European markets not as strong as they were yesterday. We've got cryptocurrencies pulling back a bit as well. Now, this means our markets this morning are flat to mixed green, and then also with the futures are showing a little bit more of a push toward the middle of the day at least. We'll see what happens towards the end of the day. These days, we've got so much market disconnect that really where you have to look is the headlines. This is definitely headline driven market, meaning that it can shift rapidly and reverse rapidly. So we've got gold is on a tear. It is just below 3,000 levels. So now we've got some calls for it to rise higher. We've also got crude oil higher. That's on some news we'll cover in a bit as well. Now, I'd like to bring something up that it seems nobody's watching. Again, I know I've spoken about this before, but we've seen how this can happen in the past. And this is, again, Bank of Japan. It's in a disconnect again. We've got the ex-Bank of Japan deputy, Nakaso, seeing Bank of Japan hiking to 1% and perhaps beyond. Now, it doesn't sound like much if you're not into the bond yields or forward, but that is a very large amount. And why we have to watch this is because they are the largest holder of United States debt. So with the MMRI, the reason we watch this is because of our 10-year yield and our dollar are both factors in this. Now, when these get hit, they do have an effect on the markets in a very large way. The debt market is larger than the stock market, if you're new here, by magnitudes. So debt market will be the first one to crumble. Take a look at our calendar. So yesterday was a quiet day. It was closed. Today we're not expecting a lot really. Home builder will be kind of what I'm watching. And then we are looking at a couple of Fed presidents that will be speaking. So not so much today as far as going into tomorrow. We are going to get the Federal Open Market Committee meeting minutes. So that will have some interest if they have anything as far as guidance for cuts going forward. So a couple of stock specific news. We've got Intel up again in pre-market. This is because they have a possible deal with Broadcom, and Taiwan Semiconductor is TSMC. So with this, there's possibility that could be bought out, merger. So it's definitely positive for the stock at the moment. However, again, could shift and reverse if they drop these talks. So urging caution on that trade, or at least hedging. Now, Peter Schiff, if you know who he is, if you don't, he is a large gold bug, but he is warning of a slow motion train wreck, financial disaster that's on no one's radar. I'm going to say almost no one's because we're talking about it. And it is the Japanese government bond yields. Now, Peter doesn't normally warn about a little bit more macro things like this, but he does have a quite good understanding of some of the larger movements. Now, he's warning about the Japanese government bond yields as well, hitting 15-year high. So this is very significant, and we've got to watch this. Could happen with that yen carry trade, is what they've been calling it. But this could definitely have a shift at any moment, depending on what the Bank of Japan decides to do. Now, it's happened for the most part up until recently that prior to making any movements, they kind of had a low level agreement that they would let the United States know first. But as of late, they've been not letting any ideas out prior to making their decisions. And so that's kind of been much more of a market mover. Okay, now this is coming from former President Medvedev, Russia. In his words, saying a rabid animal, Kiev, is biting the master's hand. Now, saying this because there was an attack on Caspian oil pumping refinery area. And what this did over there is this is hitting United States interest as far as energy. So this is the main driver for that spike in the oil price that we're seeing this morning. So may not last as this kind of meters out, but this morning oil definitely up. So back in the United States, we've got a few things going on with the airlines. They've been having very rough time lately. We've got Southwest Airlines. Their stock is moving because they're about to cut 1,750 jobs. Now, this is roughly 15% of their corporate jobs. They've never done this before. This is moving to cut costs. So cutting costs, losing jobs is good for the company because right now the stock is going up. And the problem with this is non-voluntary layoffs. In other words, they just told people, sorry, you don't have a job. And this is the first time they've done this in their 50-year history. The other portion that is interesting in this is that these are higher level positions, corporate positions, all the way up the chain of management. So we are watching the issues spreading. We've spoken about this before. The unemployment rate is going to increase. Now, we've got along with this over in Europe, German manufacturing job losses are increasing the fears over industrial decline. We've been speaking about their industrial decline because they're in a very difficult spot right now. And if they go down, they're dragging the EU down with them. They are the powerhouse. So, one more moment back to the airlines, there was another incident in Toronto. Had a Delta plane flip over upon landing, and all of the snow and massive storms that are hitting in that area. However, everyone made it out safely. So that's a good thing. There were a few minor injuries, but not good for the travel industry in general, particularly not the airlines. So I want to bring up Lockheed Martin. General Dynamics are rising. These are defense sector stocks. They are the very basis of the military industrial complex companies, a couple of them, there are more. And they are talking about the peace talks in Russia are moving these stocks. The interesting thing is that some of them are increasing because Europe is now bolstering their uh, peace, as they're saying, defense area, which means more military spending. Now, real inflation, these are the charts we need to start watching. And these are, I'm going to move eggs into the commodities sector. So if you look at this chart with the inflation that's happening, it's following similarly to cocoa has been another one recently. So we are watching resources become scarce, prices spiking, and these are the issues we're going to see going forward. So cocoa, eggs, we're going to watch meat, beef, follow some of these same pricing patterns that we're seeing here, skyrocketing basically. We've got UBS and Goldman Sachs boosting their gold forecast. They're saying over 3,000 in the next month or two. And with the current price of gold, it looks very realistic. So these are all because of inflation. When you boil it down to it, it's because the dollar is losing value at rapid pace and these resources are becoming scarce. So we've got all of these dollars chasing less resources. So that's causing these severe price distortions. Now, turning to banking for a short moment, we've got cash levels at a 15-year low. Now, this is a survey by Bank of America. This is very dangerous. Now, we know banks are pretty much bankrupt. They've got their cash levels at this 15-year low. We're running into this stagflationary environment where there is some tightening going on and there is also inflation in increasing. So as this continues, that's stagflation, and it's causing some very difficult spots. Now we've got in the midst of this Wells Fargo shedding a fourth consent order. This basically is a trouble order. They've been issued. These latest ones are coming from the Fed. So they're not in a good spot as mega bank. We've got JP Morgan having some issues as well. I don't expect them to go down, but even they're showing weakness in some areas. And this all boils down to Americans finding it more difficult to pay down their debt. This debt goes everywhere from the top, which is housing, down to their vehicles, down to non-secured debt, which is credit cards. Those will be the first ones to be defaulted on, along with the short-term buy now, pay later. So we're beginning to watch these cracks spread even deeper. We're watching a lot of papering over, if you will, with the problem, and that just means more inflation as a kind of spending to get the way out of it. So with all of these other unemployment rising, less employment issues. This is the marker that we're going to see as the unemployment numbers shift, and they will rise. The reported numbers, I expect, if they continue the way that they are reported, probably hitting 15%, 10 to 15%. Realistically, it would translate to 20 to 25%. So thank you all again for being here. We all know how to prepare, ready for what's coming forward. If you're new here, thank you. And if you want to know more, stay around. If you can, make a comment, anything you'd like to about this, any feedback on this, or anything you would like to see on this. So until I see you again, my friends, I wish you a wonderful day. And until I see you again, stay free.